This video is sponsored by Real Vision.
Santa Claus, something terrible has happened. Everybody keeps saying a bear market is coming, but I don't really know what that is because I'm just a kid.
Ho ho ho! Well, hello there, little Penelope.
That's not my name.
You're not old enough to have lived through a bear market, are you? Well, let me tell you about...
You should really cover your mouth, Santa. Santa, smoking is bad.
What were we talking about? Bears? Yeah? Bears? Well, in that case, you should see my wife.
Oh no, this isn't gonna work. But who's gonna teach me about bear markets for Christmas? Don't worry, small child, because AK is here. Just forget about that degenerate Santa Claus. I will teach all the youngins about bear markets. Because really, there's a whole generation of trader bros who haven't even been through an extended down move. If you started out of college in 08, then you're a 32-year-old trader with a decade of experience in the markets, but with zero experience in bear markets. And I mean, let's be honest here, I fall into that category too, which is why I needed to make this video so I could prepare myself. I had to talk to the more experienced, wiser Real Vision folk to understand how to get through a bear market. So today we're gonna break down some of the most famous bear markets in history and see what we can learn from them. And it's all going down on this episode of Real Vision's The One Thing. What's going on, investors? AK here. First off, a bear market is defined by any market that falls 20% or more from its highs. So by that definition, most of the world's markets are in or near bear territory. But not the S&P. Well, actually it might be by the time you're watching this because markets are moving so fast, but technically we've been in a bull market for over 3,200 days, which is honestly just semantics to anyone holding FANG or financial stocks, which are both down over 20% from the year highs. Now, the average bear market usually happens every 3.5 years and it lasts anywhere from 10 to 15 months. And since World War II, there have been 12 bear markets in the S&P 500. 9 of those have just been standard bears with average declines of 20 to 40% over 11 months. And then they took another 14 months to recover those losses, which means investors were underwater in their accounts for 2 years. So that's just the average, but then there are some that are much worse than your average bear. 3 of those 12 bear markets since World War II had average declines of 51%. They were huge meltdowns. On average, these bad bears, they took 23 months to decline, and then to recover, they took 58 months. That's almost 7 years underwater. Check out the bear market in the Nasdaq, which collapsed after it hit highs in early 2000. It took nearly 15 years for the Nasdaq to return to its levels in February of 2000. So if you retired in the year 2000 and you were 65 years old and were invested in the Nasdaq, then you would have to sit tight until you were 80 to get your money back. Like we said in our passive investing video, is waiting it out really gonna work? Will you even survive the buy and hold? And things were even worse for people holding individual names like Cisco. No, not that Cisco. He's a dragon, not a bear. Cisco, who makes the hardware of the internet and who was one of the few tech companies actually making real money back then in all that fake hype, it lost 90% of its value. Cisco saw its stock at $80 a share with a market cap of $555 million in 2000. But by October 2002, the stock was down to just $8. And now almost 19 years later, Cisco has only made it a little over half the way back to that $80 a share again. But okay, so now we know what a bear market is, but how do you survive it? Well, the first step is to just stay alive. That's the most important thing to do in a bear market. Don't be a hero, just survive and advance. And the next thing is don't buy the frickin' dip. Averaging down, that's gonna destroy you in a bear market. That buy the dip strategy, that's done. Another thing you're gonna wanna do is keep cash on hand. You wanna stay solvent. The best traders and investors all love bear markets because there's a ton of opportunity, but only if you have cash to deploy. So Buffett made a killing in 08 investing in financials like Goldman Sachs, but the reason he was able to do that is because he had dry powder. Even right now, Buffett is sitting on over $100 billion in cash. He's ready. So the best way to collect your own dry powder is to sell positions into these strong bear market rallies. And it's actually funny because bear market rallies are actually stronger than bull market rallies. And that's because Mr. Market, he's real sadistic. So he likes to trick you into thinking the bull is back just so he can hammer you down again. So your best bet is to exit your positions during those rallies. And if you're looking to play defense, there's actually some sectors that do better in a bear market, like consumer staples. So companies like Coca-Cola Coca-Cola, Pepsi, Procter & Gamble, those are the ones that do well. And honestly, whatever you do, the most important thing will always be to stick to your own individual strategy and to respect your own risk management. Don't break from your plan when things get bad, because that's only going to make it worse. And if you want to see more on trading bear markets, check out a clip from this interview with Mark Ritchie on Real Vision.
The only way to avoid a big loss is to take it when it's small. If anyone has another way, I'd love to hear it. But the only way to really ensure yourself from getting in big trouble is to get out of the way when there's little trouble. And we feel like there are enough clouds on the horizon right now where we need to say it's time to sit out. And you know, in terms of the price action, we've already talked about that. Sentiment is another one though that we haven't really talked about. So one of the reasons I don't think the low is potentially in, October we did not really see a capitulatory sentiment either in terms of say put call ratios, the VIX, some of the other different sentiment indicators that like we did even in February. That violent one-day move we had in the VIX, I think was enough not just to blow up some of those short vol ETF guys, but to really, you know, put some fear and panic in the market for a short-term bottom. We haven't really seen that this go round.
Bear markets can be tough, but you can also really come out ahead if you play it right. If you're looking for help on how to do that, then make sure you sign up for Real Vision. Happy holidays, and I'll talk to you again soon.